Happy New Year, everyone. Welcome. So glad you're able to join us for HCL's latest California Sales Tax Trends and Forecast webinar, especially during this time period when it's so crucial for you. Most likely, looking at your mid-year budget update and also preparing for your next fiscal year forecast and preliminary budgets to be able to put all that together. So glad you're able to join us here right at the beginning of the year, and we can talk about the most recent trends and data that we've been experiencing. By way of introduction, I'm Bobby Young, Client Services Director here at HDL Sales Tax, and I'm joined today by Ken Brown and Susie Woodstock, fellow principals with us here. And we all work on the same team that meets with our clients each quarter to go through specifically your sales tax results and go through your forecast, which is kind of the hot topic of the season, obviously. And we will spend that time. We'll talk a little bit more specifically, but it's our big season as well to help you guys get through a little bit about HDL. So proud to serve local communities for over 40 years now. As you can see on the screen, in total, more than 700 clients nationwide now. Thankfully and blessed enough, we are also we have a 99% client retention rate. So happy to be able to serve our clients, and so thankful that you continue to see the benefits and of the service that we provide. So let's jump in. We're talking about, even though we've transitioned into calendar year 2024, we're still looking, and today we're going to be focused on third quarter 2023 results. As a reminder, that's the third quarter of the calendar year, July, August, September time period during those vital summer months. And it doesn't take us too long to see the overall results down 1.5%. Not the worst case, if you will, as it compares to the forecast that we had even up through our last webinar back in September. We were anticipating a decline of about 2.5%. So 1.5% is still better than what we had originally forecasted. Couple of industries that really moved the needle in that regard weren't as bad as what we were expecting. Here you see building construction and fuel and service stations. Gas prices, we were anticipating the decline to be a little bit more. Gas prices during these summer months actually went up a little bit, which was more consistent, or not quite as big of a drop compared to the prior year. Along with building and construction, not positive, but we did see some growth, and I think Ken Brown will be talking a little bit about that as we go through the webinar. Couple of industries where we saw growth, positive growth year over year. Business and industry, Susie will be talking about that. Think online fulfillment and kind of a lot of what we've been discussing, but there were also other aspects that kind of clicked up BNI. Also, restaurants and hotels, nice steady 2.6% gain year over year, really helped, again, kind of mitigate the overall decline that all the way up through last quarter we were anticipating to be a little bit more. On the far right, you see regionally, pretty much most of the populace within California experienced declines. Central Coast, especially with steady tourism compared to last year, fairly flat. And then the Sierras were the only region that ended up experiencing a little bit more growth compared to last year. So yes, declines. We've been talking about this for quite a while. I went back and looked at our comparative forecasts. Even a year ago, this same time, we were anticipating a statewide decline of 0.3%. So we've kind of been fairly steady in this regard of expecting some declines here within the third quarter. So not too much of a surprise. As our team got together and talked about kind of the data that we received there in third quarter, and also what we were expecting as far as forecast considerations, you can see the bigger topics here. Interest rates and inflation has been steady part of the discussion for about the last year and a half, especially as we lean into inflation. Over on the other side, consumer spending and savings trends, most notably a concern. I've got a couple of slides to go through a little bit more in detail there. Then down below here, a lot of our consumer sensitive categories, tourism, business travel, especially through the summer months, and kind of that post-pandemic comparison. Are we getting back? Has the economy gotten back to where we were pre-pandemic when it comes to tourism business travel? AB 1228, probably what we're going to be hearing about the most within the next 3 months or so, and kind of what impact is that going to have on consumers overall. Then we kind of transition that into here in sales tax, and Susie's going to be going in a lot deeper later here in the webinar on AB 1228. Then the ever-present and always right in front of us, gas prices. What are our expectations there? Most notably, thankfully enough, appears as though the crude oil markets have definitely kind of leveled and remained fairly steady, which could mean some good things for us as consumers when we talk about overall spend. Year-over-year inflation that had just come out for November, up about 3.1%, but compared to October's number, which was 3.2, slightly down, still well above as far as inflation goes, where the Feds would like it, kind of below a 2% inflation. So it kind of transitions us here into interest rates, and all the topic, especially last month as the Fed Treasury had their meeting, or the FOMC had their meeting, talking about their overall goals for interest rates, holding steady, as you see here on the blue line going across. Obviously, our trend, we're still in total up 525 basis points back when compared to before the Fed began raising interest rates. But a headline, and one of the things that we've talked about so much over this last year, is really watching the Feds and what is their expectations. It really is on this soft landing. I'll kind of show through a couple more slides what how we see that soft landing, how we've viewed it, and how we see it rolling through the data. And I think we're getting pretty close. It is the main thing for 2024. How are the Fed's going to continue to inspire the economy, keep it going, but not too much, and definitely not pull it back. So rate cuts. If you're asking me on a personal basis, I think I lean more on the optimistic side that the Feds will be reducing interest rates, probably starting late spring and in the summer months to really kickstart the economy again as far as growth. As a reminder, and I think I've mentioned this before on past webinars, November 2024 is going to be a national election. And I think that's really kind of the lead in from my perspective of the Feds kind of getting interest rates down, economy going in a lead up to that November timeframe. The other focuses for us, consumer spending. As you see here, especially during the pandemic, post-pandemic, the double-digit gains that we had experienced for quite a long period of time cooling off. Here we are now, later in 2023. You can still see consumer spending in a positive fashion, although it hasn't necessarily trickled over directly to sales tax. And that really kind of leans in between, kind of the discretionary versus demand spending. Are consumers really looking to spend more on experiences rather than goods, right? And kind of having that balance. But it has most certainly trickled off, comparatively speaking. And on that consumer side, the other thing that we are watching so closely is the rise in overall revolving consumer credit, which you see here on the left-hand part of the screen at an all-time high. While then on the right side is delinquencies, and being able to kind of see here that both auto loans and credit card, as far as delinquencies goes, starting to get on a rise and a little bit more consistent with where those levels were pre-pandemic, which you see here. The drop overall for student loans, definitely down comparatively, which I think kind of helps balance the picture. With mortgages being the blue line here, kind of tough to see, but you can see up on the rise as it goes to delinquencies, rise in interest rates, especially mortgage rates. Probably not too much of a surprise, but it is still lower than where we were. So in total, we've seen a surge in overall credit and delinquencies, but there are some maybe some good things or things to offset the fear factors there, most notably is savings. So the personal savings rate, something that we also watch just to keep that balance of the story. For the third quarter, savings rates remained at 4.2%, slightly lower than where they were in the second quarter, but still at a fairly good level. And again, allowing folks to have a sense of savings, hopefully pay off those the increase in revolving credit um, to keep the economy going. Then California unemployment, you see a lot of green, remaining at a fairly low level, still slightly below the 5%. November 2023, we had a 4.9% unemployment rate, so still really low. And I think it'll also, we talk about this and try to figure out specifically on the impacts of AB 1228 and the increase in minimum wage. And okay, what is that going to do for overall employment? Will folks be inspired to take some of the jobs that are available given a higher income or hourly rate? So it's going to be very interesting to watch unemployment and maybe its impacts as we roll through the summer, but still, again, at a really low historical rate. Overall, you can see here historical trends starting on the left. Again, those double-digit gains that we had seen during calendar years 21 and 22 tapered off. All of 23, we've been experiencing declines here. Again, not a big surprise, especially as inflation kicked in. We had the Feds raising interest rates, really trying to kind of create, again, that soft landing, which then you see here our forecast for the fourth quarter. We heard that there was, and we saw it with consumer spending, right? We had heard national retail sales positive in a 2.5% to 3% range. Kind of very intrigued to see how that's going to roll over to California's sales tax economy once we get the fourth quarter data. But in total, still anticipating another quarter of declines. That would create now 4 quarters, the entire calendar year of declines. And when we talk about that soft landing, to only see those at 1%, it's fairly flat. And you can see then what our forecast looks like going forward, 0.5% in 1Q, positive though. And then it's really not until we hit those summer months and then look into 2025 where we start to see a little bit more growth. Again, the expectations here, interest rates coming down, consumers having more accessibility within their overall budget to be able to spend and start increasing increasing overall statewide sales tax. I've marked here the blue, these blue quarters, really designating the fiscal year. And I think this then leads into the period a lot of you are coming up with, which is your mid-year budget review and the expectations there of what, how you're going to speak through it. 2 quarters likely for the majority of California, 2 quarters of declines with 2 quarters of moderate increases, thereby keeping that balance for most likely fairly flat. Again, it's that soft landing. You can kind of lean into that if you're explaining that. Really not then until 24, 25. These 4 quarters out here where we see that that positive growth. So hopefully that sets the stage. I'm going to turn over now to Ken to lean into autos.
Thank you so much, Bobby. Great overview. And with that, let me now dive into the beginning of some of our major industry groups. And I'm going to start with autos. And as Bobby was mentioning, our forecasting generally has been pretty spot on the last couple of quarters. And that's the same with autos. I think we projected somewhere around a 3% decrease for the group, and it came in down about 2.6%. And so one of the interesting things about this group right now is that it's a bit of a head scratcher, but sales are coming up. As you can see here on the graph, over on the right side of the graph, we're well above where we were in terms of auto sales, number of vehicles sold during the pandemic. And yet there is a slight decline in tax receipts. And that discrepancy is really attributable to more fleet sales, but also finally, we have some more vehicles available on the lots to choose from. So you don't always have to buy that most expensive vehicle or that most fully optioned vehicle. So there's a little bit of a choice now, and reports from the industry are indicating that we're finally getting back to that traditional buyer's market. So again, sales much higher where we're at right now on the right side of the graph than where we were sort of at the bottom depths of the pandemic. But we're still, I think this is a very important note, we're still kind of below that normal level that I would look to see, similar to what we saw coming out of the Great Recession and also in the early 2000s. So there's still a bit of room to grow there in terms of vehicle volume. Now, pricing, what's going on with auto pricing? That has been such a roller coaster. I'm gonna be hitting on this theme throughout the presentation. You can see here on the left, new car prices, and then on the right, used car prices. What a huge surge we saw coming out of the pandemic. The good news here is that despite having lived through this roller coaster, we're now kind of normalizing. And so new vehicle prices pretty flat from where they were last year, and used car prices actually down a little bit. And so we are seeing a bit of a normalization here in terms of pricing. One of the factors that may prove to be challenging this year for auto sellers, however, is the rise in financing rates. And so we are above 7%. And in the table there, you can see that the average monthly payment for a new car is now $726 a month. So that's going to be a bit of a challenge for many consumers to grapple with. So summing it all up in terms of what our outlook is for the auto sales market is that in green up top, we have a couple factors that are positive. We see that new car sales are accelerating and pricing is also stabilizing finally. Also supporting car sales, the average age, I've mentioned this in the past, the average age of a car on the road now, 12 and a half years old. So yes, they do build them a lot better than they used to build them. I've always heard the people saying that even the worst car you can buy now is better than the best car you could buy 20 years ago. They last a lot longer, but still at some point, folks are just going to have to bite the bullet and buy that new car at some point. We also have the UAW strike over. We had just begun the strike when we had our last consensus forecast presentation. It is now over, so that'll certainly allow inventory to continue to grow, and that is no longer a factor in our forecasting. On the negative in red down below, we see again financing rates still over 7%, making cars very expensive. Used car prices falling, so that's going to be a bit of a drag for tax receipts for new car sellers. And also, prices are really expensive still, even though they're now stabilizing. They're up about 21% over compared to 3 years ago before the pandemic. And so that's going to be a challenge. This is going to be really interesting to play out. It's really going to be a tug of war between manufacturers who really want to maintain their profitability. Reports from the industry say that they love to have the low inventory on the dealer's lots, and they've really been enjoying a period of high profitability. But consumers, on the other hand, they're really going to want to wait, and they're going to want to wait for that deal. So it's going to be a tug of war over the next year or so as we work through this period. And so all of that played into our forecast here. We expect pretty similar results for the next couple quarters as we've seen recently. So we're looking for a slight dip of around 3% in 4Q23, another dip of about 2% in 1Q24. But then we believe that sales tax revenue will slowly grow, increasing up to more normal levels over the course of the next couple years. But we're going to have to wait for this tug of war to play out between consumers and manufacturers. The second major industry group I want to spend a little bit of time on is gasoline, fuel, and service stations. And so this has been another one of those categories, just like autos, where we saw a huge run up in prices and then a big dip. And so what is the current state of the market now? Well, right now, we saw in the third quarter 7.8% drop in tax receipts from fuel and service stations, 3Q23. But now you can see the two gold boxes there on the graph, and we are pretty flat compared to where we were a year before in terms of into December. And I just took a look yesterday, so early January, we're actually up about 6%. And so OPEC production cuts, global uncertainty, we've seen a lot of that lately. Those are supporting prices despite fairly flat consumption. So we believe we're seeing prices stabilize, similar to what I mentioned about the auto industry after a huge run up and now a subsequent drop in 2023. We think that we're going to see modest growth going forward. It is true. A lot of people ask us about the electric car and what that is doing to the market. Electric car sales are now 25% of new car sales in California. But we believe this will be a long transition and that tax revenue from fuel cells will continue to grow modestly for the next 5, 6+ years. As gasoline cars get scarcer, we believe that fuel costs will only go up as refiners constrict supply, resulting in relatively flat tax receipts for the next few years, as you see up on your screen here in terms of our forecasting. Building and construction. So this is another one where we've seen some declines lately. We saw a huge run up, but it stabilized in the third quarter. We were down, but we were only down 2.6%, far better than the 10% decline we saw in the first quarter and 5% and change in the second quarter. So we are normalizing. A couple of the major factors that we're looking at in terms of our outlook are what you see up here on your screen. First and foremost, material prices. And I would highlight lumber in particular. Lumber has been a huge part of the story in recent years. During the pandemic, a tremendous spike, and then recently a tremendous drop in pricing. So I'm going to spend a couple minutes on material prices. I'll share a slide or two with you on that. Secondly, we also have weather. Last winter was the rainiest winter in California, as I understand it, in 28 years, and it certainly had an impact on last year's tax receipts. Our initial expectations were that this winter was going to be similar in terms of the weather, but as we sit here today, it doesn't seem to be the case. So far, we seem to be a little bit sunnier, at least here where we are today. And so far, I think that is playing out well, and that could indicate good things to come for 4Q23 results and also 1Q24. Now, affordability, interest rates. Interest rates have really been the cherry on the top in terms of difficulty in making what is already extremely expensive housing in California hit levels that very few families can afford. So I'll share with you a graph on that topic. We are also hearing that high financing costs recently are preventing some multifamily projects from penciling out, therefore preventing some badly needed housing from being built and further depressing construction spending. And then we're also looking at some other constraints on housing in terms of our forecasting. One of the most basic constraints is an available labor force. So many skilled contractors and laborers left or retired the industry in the wake of the Great Recession many years ago. So that labor now is a constraint on building more units, and particularly at a reasonable cost. And furthermore, we're also even hearing that the electric grid is a constraint in some jurisdictions trying to hook up new homes where there's not enough capacity, with 1.5 million electric cars now on the road in California and more coming, plus all our gadgets and electronic devices. We are certainly living in an electricity dependent world. So turning to the first factor, lumber prices and material costs, the good news here is that just like for auto sales, in auto pricing, we're seeing here now that finally, after a tremendous roller coaster, and this graph only goes back to, I think, 2022 because of a change in the index. But believe me, there was a huge surge in pricing before this. Looking now at the period that we just ended, 3Q23, as you can see on the graph, we're roughly flat compared to where we were last year. So that means some relief in terms of the cost of construction inputs. So that is good news in terms of construction. Concrete, some of the other factors that we're looking at right now. Concrete, as you can see here, this compares to today versus a year ago period, still about 9% higher in terms of ready mix concrete pricing. However, the good news here, just like the other things that I've been talking about today, also pricing here is starting to stabilize. The last month, November, pretty flat compared to the previous month, definitely starting to plateau out. So just like lumber, we expect that concrete pricing will be less of a factor going forward. And it's also, I could mention, roofing contractors, plumbing contractors, electrical contractors, all of these up anywhere from 2 to 9% year over year. But like concrete, like lumber, like autos, the pricing is starting to plateau and flatten out. So all in, this is our forecast for the building and construction segment. A couple of additional intelligence, Home Depot and Lowe's still reporting declining sales in their most recent earnings reports. But the bottom line is we think that there's hope in the second half of 2024. Uh, so turning to this forecast, we see tax revenue growing again at more normal levels in the later part of the year. We have an acute shortage of housing in this country, and particularly in California. Interest rates, material costs, labor shortages are three significant constraints. However, we expect, as Bobby mentioned, to see interest rates fall later in 2024. This will allow some projects to pencil out that are currently stalled, unfreeze the market a little bit. Homeowners will be a little bit more likely to make those improvements that they've been waiting on, holding off on. And so we think that this reversal in interest rate trend will be what the market needs to move forward. Furthermore, material prices, as we talked about, normalizing a little bit. So two of the three biggest restraints holding back the sector are diminishing. Yes, we're going to continue to grapple with affordability. And then there's other issues, zoning, labor shortage, all the things that we talked about. But we see the industry group slowly coming back and moving forward towards the second half of this year. Finally, food and drugs, my last major industry group category. And this is typically one that we don't pay a lot of attention to because it is the smallest industry group, but there's a couple of developments that I thought, let's pay a little bit more attention to it this quarter. And so one of the major subcomponents of the food and drug category these days is cannabis, tax receipts from cannabis. And as you can see on the left, there's a graph there, and we've been on a long slide in tax revenue from cannabis that's really held back the food and drug industry for a while. The cannabis group now comprises about 23% of overall sales tax revenue for the food and drug major industry group. So it was down again this quarter, about 3.3%, as we see continuing competition from illegal sales and also oversupply, lowering prices. But we're starting to see a bottom form here. And so I think that this indicates that cannabis going forward will be a little bit less of a drag on the overall industry group as it has been in recent quarters. Drugstore sales, that's another component of the food and drug category. It was down about 6%, and it's been in the news a lot. You've probably heard about Rite Aid closures. You see all the California closures up on the screen right here. I want to allay your concerns a little bit. For most jurisdictions, this is not going to be a major impact for you, but it's more of a symptom of oversaturation of the retail pharmacy landscape, and also sort of what we've been seeing playing out throughout all our categories, a result of a post-COVID shift in consumption and consumer habits. So fortunately, we're not needing to go to the drugstore quite as much as we used to. And so that's playing into this dip, and it's something we're playing into our forecasting as well. Finally, over on the left side, I've got our overall forecast here, but also I want to focus. The biggest decliner this quarter was liquor store sales, down 9.8% within this group, really led to the overall 2.6% dip in food and drugs. So I always try to bring an interesting statistic or something to share with you guys in these meetings, and I didn't want to disappoint you. And so I dug this one up for you coming out of the holidays, is that during the pandemic, alcohol consumption reached the highest level since 1988, about 597 drinks per year for every American over 21 years old. So if you do the math, that's almost heading towards 12 drinks a week on average for everybody over 21. So I think Some of this decrease in alcohol sales really is more a result of a return, like everything else we've been talking about in the presentation, to normal consumption patterns. We're kind of drying out a little bit after the pandemic days. So I think that is a major factor here. But also, as Susie will talk about, folks are eating out again and folks are drinking in restaurants and not just at home. And so folks are buying that alcohol at the restaurants and not just at the liquor stores. I think the other factor here too is our database. We do a great job of categorizing these things, but there's always going to be challenges in categorizing convenience stores between gasoline because some of them have small gasoline stations and some of them are more convenience store operated. And so part of this decline in the liquor store sales is there is some gas spending leaking into this category. Gas prices down contributed to the overall decrease. So that all played a role as well. Not going to be as much of an issue going forward. Finally, the most important factor in this, grocery store sales up 2.3%. Most food sold at grocery stores is tax exempt. So what you're talking about here is you're talking about alcohol, of course, but also sold at grocery stores, but also paper towels, other similar products. And so grocery store sales still up. We think basically the bottom line is that we'll see some modest growth going forward in food and drugs. It's going to be a little bit lower than we typically see for the next couple quarters, but then normalizing as cannabis and also alcohol becomes less of a drag on this data going forward. So with that, let me turn it over, please, to my colleague, Susie.
Thank you, Ken. We will move on here to the general consumer goods group. General consumer goods contracted 2.7% in third quarter. It was projected to contract about 3.2, so it did a little bit better than expected. This slide is showing the major categories in the group, which had varying performance this quarter. The largest category at the top there, discount department stores, which is 31% of the general consumer group, was up this quarter. Just barely, but it is up. Discount department stores has several taxpayers that roll their fuel pumps into the main account, so fuel can have a slight influence on this group. But this quarter, the positive results are from an increase in merchandise sale. The fuel was flat quarter over quarter. Although this growth is slight, it is better than expected and part of the reason why the overall results for the group were better than projected last quarter. Also performing better than expected was the family apparel group here. Family apparel group is right in trend with most recent readings of consumer confidence. Foot traffic in stores with off-price concepts remained strong, leading to this 3.3% growth in family apparel. Two categories on here with big declines, which is consistent with recent quarters. Home furnishings, this is down due to soft demand for big ticket items, but also we're still seeing the influence of some of the store closures in this category. And then electronics and appliance stores also saw a big drop. So factoring out the discount department stores entirely, the combination of the other high impact categories, which we see listed here, have contracted 5 consecutive quarters, seen here on the solid line. A tightening in family budgets, elevated interest rates, diminished savings have reduced demands for some of these durable goods, the same things that we've already talked about on kind of a global perspective. A larger portion of consumer spending is shifting back to those non-taxable services and experiences. The dashed line is showing the outlook for the high impact categories, which expects a couple of more negative quarters and then mild growth to begin in the spring of 2024 in these high impact categories. So rolling that information into the forecast for general consumer goods, the forecast shows we expect spending to continue to slow for the next 2 quarters. This includes negative results for 4Q23 and 1Q24. This holiday season, we heard hype that holiday spending was way up, but most of that is related to online shopping and shows up in different major industry groups. Several major retailers' financial reports indicate that their brick and mortar stores experienced 3 to 7% declines for fourth quarter. But after these 2 more quarters of slowing, we expect to see the group start to grow at 1 to 1.5% for the next couple of years. Now we'll move on to the major industry groups where online shopping shows up. Here, the first one is in the county pools. General consumer goods in the pools are from online shopping where the merchandise originates from out of state. It is the largest category in the pool, and it was down 6%. This is mainly due to more online shopping items originating at in-state fulfillment centers. So again, not necessarily a slowing in spending. Again, we heard the online hype, but this is the out-of-state merchandise. Other categories in the pool include autos and transportation. This is mainly the distribution of sales tax from private party used vehicle sales. And as Ken mentioned earlier, used car pricing is dropping. And in combination with a big spike in third quarter 22, the autos and transportation in the pool dropped 17% in third quarter. Other categories, building and construction, you can see a slight drop. Business and industry, which contributes almost as much as the online sales, was up only 4%. Business and industry can have big fluctuations due to the energy sector in this group, but it was flat this quarter. Also on this slide are restaurants and hotels. So this ends up in the pool, not because it's coming from out of state, but because some delivery services are processing payments for the meals they are delivering. They're offering that full service delivery option for restaurants, but the delivery company does not own the food at the time the order is placed. And if they don't own the merchandise at the time it is ordered, the sales tax is distributed through the pools. It's a small portion of the pools, but this is about 3.5% of statewide restaurant sales tax that moved from direct allocation into this indirect method a couple of years ago now. Okay, let's take a closer look at general consumer trends versus the rest of the pool. This slide is showing the percent change for general consumer goods in teal, and the rest of the pool is in blue. The general consumer goods had a big jump starting in 4Q19 with the implementation of AB 147, the Marketplace Facilitator Act. And those gains were furthered by the pandemic frenzy. But then the allocation decreases. This occurred because companies increased the use of those in-state fulfillment centers, changing the reporting from the indirect distribution via the pool to direct allocation to agencies where those fulfillment centers are located. There was another small shift here in 4Q22, once again increasing the use of in-state fulfillment centers. The fulfillment centers show up in the business and industry group, so I'll talk a little more about that in a few slides. The blue line shows that since 2Q21, growth in the pool has been primarily driven by other major industry groups. And in 3Q23, those other groups also went negatives, with that drop in autos that we just saw on the previous slide. To illustrate the growing utilization of in-state fulfillment centers a little further, this slide is looking at all online sales. The top line is the portion that is distributed via the pool, major industry group we're looking at right now. And the bottom line is the direct allocation to fulfillment centers locations, again, which will be in the business and industry group. In 1Q18, the split was about 78% to the pools and 22% direct allocation to the agencies with the fulfillment centers. And now in third quarter, we're at about a 58-42% split. You can see that the first drop occurred in 1Q21, and then we had another again in 4Q22. This is showing that the general consumer goods decline in the pool is not a slowing in overall online purchases. It is that shift in reporting driving that decline. So with that, went too far. With that, here's the pool forecast. This is showing 3Q23 came in down about 3%, which was a bigger drop than the projected decline of about 2%. Going forward, we have one more quarter of slight decline, then flat, and then the pool is going to start stepping up. And again, kind of the same thing that we've heard, that it's going to start growing in fiscal year 24-25. So a little bit more slowing of this year and picking up again next year. Now we move to the business and industry group, the group that is getting the gains from the online shopping shift to in-state fulfillment centers. Fulfillment centers are now about 27% of this group. The gray columns are showing that dramatic percent growth in 2020 due to implementing AB 147, and then in 2021, the shift to direct reporting. But starting in 3Q 2022, you see that the gray bars bump up again. And it was 4Q 22 that we saw previously that new in-state fulfillment centers were implemented in this time period. And so we saw another bump up. You can see these in-state fulfillment centers are creating a general consumer good pattern with the fourth quarter spikes. So moving on from the fulfillment centers, I've talked a lot about those, to some of the other 21 business types in the business and industry group, ranging from industrial to farm equipment to wineries to medical biotech to motion pictures. Business and industry is a very diverse group. Here are the top 10 business types in the business and industry group. These top 10 are about 62% of the group. You can see on this chart here, heavy industry and light industry had the biggest declines. Light industry was down about 8.5%. Heavy industry was down about 5.8%. Both are facing inventory, pricing, labor, and demand challenges that are driving down their returns. So looking at some of the considerations for the overall business and industry forecast. First, we've got the fulfillment centers. Like I said, it's over 27% of the business and industry group. In third quarter, it was up 18%. Again, we're seeing those shifts. So this will have an influence on the overall business and industry group. Second, U.S. manufacturing index contracted for the 13th straight month with capital investments limited by borrowing costs. This manufacturing index influences the projections for heavy and light industry portion of business and industry, which we saw on the last slide. Those are the second and third largest categories besides fulfillment centers. Then we still have the medical and biotech rebounding from the pandemic highs. So this is still transitioning back to, again, pre-pandemic type levels. And lastly, we're expecting agricultural spending to start improving. The farmer sentiment is up. They've had supply constraints and high input costs and drought over the last year, and we're expecting to see some improved conditions for the agricultural industry. So considering those influencing variables for these various sectors, the projection expects modest overall improvement for this diverse group on a statewide basis. Fourth quarter is expected to gain 1.4% on top of the 8.4% from last year. Given the unique composition of this group, projections can vary for jurisdictions based on the size and character of the businesses in each community. Overall, though, we're looking at, on a combined basis statewide, about 2% growth going forward. Okay, we'll move on to restaurants and hotels. And there's a few things affecting this group. The first is we've had menu prices are expected to remain high. There's been all sorts of factors that even though the prices went way up, the restaurants cannot bring those prices back down. With that, they're leaning on marketing to value offerings. So trying to find a way to appeal to people who want maybe a little bit more price conscious offering. They're doing this on all levels of the menu. They're offering, high priced value options, as well as trying to get those lower price value offerings. Overall, the industry is reporting that foot traffic is slowing. really it's slowing to kind of some of those higher cost options. Fine dining was one of the categories that was negative in this group. Lodging, the hotels remains below pre-pandemic levels, although prices are high. The industry says they do not expect room prices to go lower. Right now, those higher room rates are offsetting flat occupancy rates. Kind of a positive note, expecting international business travel to finally start to return. This is one of the sectors that has really lagged in this group, and it was an important sector prior to the pandemic. This is a sector that spends a lot more than a recreational traveler. And we are expecting international business travel to start to return in 2024. Like Bobby mentioned, this new law is going to start April 1st. It establishes a $20 per hour minimum wage for fast food workers. Fast food is defined as a restaurant where patrons pay before consuming and that they have at least 60 establishments nationally. So it has to be some sort of chain. On January 1st, 2024, a few days ago, our current statewide minimum wage is $16 an hour. It actually just went up to 16. It was $15.50 last week. And several agencies have adopted higher rates on their own. So the minimum wage rate varies throughout the state. With the recent labor shortage, there are several fast food establishments that already pay well above existing minimum wage and will have to make little or no adjustment to their pay scale to adhere to this new rate. But a lot of fast food restaurants will be significantly impacted by the higher labor costs and will have to raise menu prices again. To limit the increased costs, we expect the fast food industry to expand the use of automation, such as ordering at kiosks or via online apps instead of through a person. There is concern that this could exacerbate the labor shortage with workers pursuing fast food jobs. But even with this higher minimum wage, these workers will still make less than the average tipped worker. So I don't expect casual dining restaurants to see a worsening in their labor shortage, but it could create a little more competition for other industries that pay the $16 minimum wage. These impacts will also be felt stronger depending on the region. Areas where they already have fast food that had to raise it up. There was several chains that were at $20 an hour in the Bay Area or in Southern California. But some of the more rural areas might not be at that minimum wage yet. And so regionally, this could hit a little bit harder to areas that did not have the wage up. But even with that, we expect that the industry that is very conscious of the tipping point of if you raise your menu prices too much, people stop going out to eat. Even with that, we expect people will continue to eat. The restaurants will raise the menu prices as much as they think that the market can handle. And so we'll see the prices offsetting the labor costs going up a little bit, and people will still eat out. With that, this forecast is expecting to see that increase in menu prices that will start in second quarter. There's still consumer sentiment that we're looking for value meals as household budgets tightening, keeping the overall forecast to 3 to 4%. Fast food is about 30% of the restaurant and hotel category, and we expect about half of that group will be subject to the new minimum wage. So that's why it's only bumping this up about 1% from previous estimates. And with that, I will hand things over to Bobby.
Perfect. Thank you, Susie. Thank you, Ken. Deep dive there, right, into each one of the major industry groups. Hopefully, Each one of you as attendees got a chance to pick and choose some of the talking points, especially as you think about your local jurisdiction and how it might directly relate to your local sales tax. Susie, with the great hotel comparison there, also adds to your possible TOT revenue forecast, really understanding that just because the nightly rate's gone up, maybe the occupancy is a little bit lower, and really kind of understanding those comparisons and the attachment when you're forecasting revenue. Then Ken, I don't know if I'm going to be able to get past the 11 drinks per week. Nice additive stat there. I know I'm not reaching that, so there's a bunch of others that are likely well above to come up with that one. But yeah, thank you guys for that. So as we kind of wrap up, looking at it on a fiscal year basis, you can see, we're coming off of 2 years double-digit gains. We talked a lot about that. Budgets, revenue, total revenue increased and thereby felt a little inflated. We saw it start to cool off and slow down in 2022-23. Our anticipation is this soft landing, if you will, fairly flat overall for fiscal year 22-23 as we navigate through possible interest rate changes. We have a national election. Also, we are hearing from a lot of jurisdictions considering a new local tax add-on revenue, sales tax revenue, and transactions and use tax, to be a part of the election process come November. So a lot to consider there. Then as we look in the out years, you start to see that return of normal historical growth, 2+% going out. Not even though we talked a lot about the headwinds overall, isn't anything that we see on the horizon right now to say dramatically we're going to experience a recession or a bigger pullback, which would stagnate or really pull down this growth that we currently have built into the forecast. So hopefully some of these, again, help you as you navigate. Actually, I think I got one more here. Yeah, these, especially these next 2 fiscal years, as you look at preparing your next fiscal year budget and what our expectations are. So as a reminder, we'll be meeting with clients coming up here in the rest of the month of January and February to really go through your specific third quarter results. We'll be updating forecasts by default and bringing those out to you during this January, February timeframe. Also, as a lead in and our expectations, we'll get fourth quarter data. We'll receive that in March, kind of go through our normal process, be looking to meet with all of you during April and May. And again, updating forecast by default for each one of you during that period. So we've got, we are all in this forecasting season together, but just a kind of a reminder there as what we're expecting. And then also starting next week, you can see on the screen, be on the lookout. We're just going to be asking for a little bit of feedback from all of our clients with a client survey. Feel free to be as honest as possible as you'd like. We'd welcome any constructive criticism you may have, or just that you enjoy our service, which is always a welcome response. So be on the lookout for that. We're going to be hitting the Q&A section. So just if there was anything as a reminder, if there was anything that came up during the presentation that maybe triggered some questions for you, some wheels, feel free to put it into the chat. We've got a couple that we'll be addressing right now to go through, but if anybody else has any, feel free to put it there. We're at 11. We've got a few minutes here that we can spend some time doing the Q&A. First and foremost, we had question, any analysis out there as to how higher minimum wage translates to higher spending on consumer goods? I think Susie and I we were kind of laughing about this just yesterday, especially as it relates to AB 1228 and the restaurant industry. And okay, what's going to be the impact here as minimum wage goes up? And I think we kind of come to that maybe basic conclusion is if minimum wage goes up and it is then translated back into the cost of goods, it means then likely if people spend the same amount, it's just a higher price. We're going to see sales tax continue to bump up a little bit. I know Susie's beat it into my head and hopefully to everybody else. The AB 1228 is specific to the fast food industry, which is a relatively small sector within even the overall restaurants and thereby overall sales tax. So going to be probably not as tangible when it comes to the bottom line, but it is a part of the picture. As higher minimum wages continue in the future, a likelihood is we're going to end up just in that general sense, we're going to end up seeing a continued increase in sales tax revenue overall. As people have more money to spend, they will spend more. It's kind of been the way of our economy, especially here in California. Susie, Ken, I don't know if you guys have any more that you want to add on to that answer.
No, but I can take the second one on GDP.
Oh, you want that one?
Yeah, you can jump in. I'll just share my thoughts and then jump
Fire
in.
away. Yeah.
Basically, GDP, the question was, to what extent and when or how does GDP not necessarily align with taxable spending or with sales tax? And I think the most important thing to note there is basically these days, remember that sales tax is derived from the purchase of tangible goods. That is much less of a component of the overall economy than it used to be. Nowadays, we're a service-based economy. We're buying stuff, a lot of digital products that are not taxed. And so it really is not as much of a factor as it used to be. That being said, GDP certainly is an indicator of the health of the overall economy overall. And I cannot think of a time when GDP dipped and sales tax did not also dip. Now, you might say, hey, wait a second, what about this time? Well, remember, because GDP is still positive, but remember, GDP actually dipped back in 1Q, 2Q 2022, and everybody was arguing, hey, we've got a recession going on right now. But we were seeing at that point in time sales tax, surge. I think what just happened coming out of the pandemic is there was a delay in that relationship, and we're seeing that little bit of a dip right now. So I can't think of a time when GDP fell and sales tax did not also fall, even including this time.
Yeah. No, I think you got it. You took it right out from me too, is, GDP of what's included there. It's not just taxable goods, it's non-taxable goods, it's services. And whereby, when we're looking at sales tax trends, it's only what's taxable. I think I'd also add in there the fact that there have been numerous exemptions overall on what sales tax is charged on. And I think as we continue to watch bills coming out of Sacramento, we just got an email this morning by one of our teammates that said there's a possible snowmobile exemption that working its way through Sacramento. And so even that, which would be kind of like, I guess, similar to like a motorcycle, a sale to an end consumer might end up getting an exemption. It would be included with GDP. Not so much when it comes to sales tax if that exemption goes through. So yeah, I would kind of echo Ken's thoughts and then even add on to the exemptions that here in California, our state legislature has enacted over the decades of our revenue and taxation law, and that to help with the overall comparison there. And I think that's about it. Ken, Susie, anything else that you guys have? Very good. Then as a reminder for everybody, feel free to subscribe to our newsletters, our webinar, be on the lookout for our survey coming up starting next week, and we'll also be looking to make sure that on your calendars for January, February, look forward to the teams meeting with each one of you to go over your specific results and the forecasts that we are going to work so hard to get done for you. With that, Happy New Year again. So thankful that 24 is here. We put 23 and those declines behind us with the hopes of what's to come in 2024. And we look forward to seeing each one of you guys very soon. Thanks so much for joining us.
Thank you.